Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. It is that time of the month again where we look at five different companies that are undervalued that pay dividends, and we will also look at another video, five different companies that do not pay dividends that are undervalued at the moment that you could potentially look into for the month of October, inshallah. But before we do that, just a couple of things that I want to talk about. As always, join us on the Patreon if you can, join us on the Discord, get access to the ebooks, and that's in there, as well as all the trackers that I've put together, inshallah. But before we do all of that, there's another thing that I want to talk about. By the way, if you haven't liked the video, please do so. It really helps the channel. Of course, it doesn't cost you a penny. You just press that button and really helps the channel. But one thing I want to talk about today is the Fear and Greed Index. This is where we are now, extreme fear. And now a lot of you are talking about, especially people on the Discord, basically have mentioned it a few days ago, that things of course are going down. This is every single day you look at the stock market, it's going down. Although it's not going down as much as 2022, where we were down some days, the Dow Jones were down 700 points, whatever. But right now things are going down and everyone is fearful. They're worried about recession. They're worried about basically where the next meal is coming from and so on. So right now we're here. It wasn't not long ago, it was 2021, end of 2021, we were in extreme greed, but right now we are here. Remember what Warren Buffett always said. He said basically be greedy when others are fearful and be fearful where others are greedy. And right now we are here. So what this tells me is we should now be looking at opportunities, in the stock market where we can buy quality companies and leave them alone. In a couple of years down the line, we will forget that. Remember, it was a year ago, we were here. Everyone was buying when it was here, and now we're on the other side. So cycles change, but for the long run, things will stabilize and you will make at least a 7% on the basically in 10-20 years time frame. Now what's happening here in this little graph here is basically the 125 day moving average. So when the blue line is below this line, then that means everyone is fearful, and when the blue line is above the orange line, then that means everyone is basically bullish about the market, everyone is greedy about the market, things are wonderful. Basically everyone is telling you to invest in this stock market, and right now everyone is telling you not to invest, and that's probably the best time to invest. I'm not saying I'm financial advisor or giving you advice to put your money into work right now, but that's what I'm doing. I'm adding money to every single week. Right now I think I've got about £300 or so. There we go, £361 that I will be investing into today's market. So inshallah, I'll let you know what happens on the Discord. But yeah, every single month, every single week, I will be adding that money. So no matter what happens, whether markets are up or down, I will definitely dollar cost average every single month, especially into stocks that are down quite a bit. Think companies like AstraZeneca, companies like ASML, the business model has not changed. Nothing has happened to the company. What's changing is the overall market and the sentiment has slightly changed, but the companies are still doing well. Their product is still selling. Things are absolutely fine. Of course, when if recession happens, things might slow down for certain companies and so on. Again, that's part of their business. That's part of their businesses. Some of the business are very cyclical. That means sometimes they will sell a lot of products for a couple of years and then it might come down a little bit. But if you are a long-term investor for 10-15 years, you don't have to worry about that. And a lot of people are fearful because of this. Look at this, 1 month is actually 4.6% down. That's the S&P 500. The Dow Jones as well is down almost to 4%. The QQQ, which is basically the Nasdaq 100, is also down about 4%. So this is the reason why things are fearful right now, and I understand that, but it's not the most important thing for us as the long-term investors is think about the market for the long run. Don't think about just what might happen this month or next month. This time next year you will forget all the things that we're going through, I promise you. Do you even remember what happened September 20 or October 2022? No, because you've forgotten about it already. And now we're going to look at 5 different companies that are undervalued. All of them pay dividends. All of them are Sharia compliant, and I will show you the Sharia compliant screen at the end of the video. So nothing has changed, it's the same thing. So the market cap, we're looking for the MOT rating, we're looking at the price, dividend yield, the payout ratio, the latest increase, the 5-year growth rate, the dividend streak. annual payouts, the safety, profit margin, return on equity, return on invested capital, the free cash flow, the total return including dividends as well as price appreciation in the last 10 years, the next year expectation for the earnings, for example, and then the following 5 years. And then the most important part is the Morningstar valuation, which tells us these companies are undervalued at the moment. So I didn't do this calculation myself. This company has done it. I'm just using the information. If you want to do your own discounted cash flow models and so on, then completely fine and do that. But that's what I'm using here. Okay, so just to be transparent. Okay, before you guys say what is going on here, whatever. Okay, first company is TSM. This is probably one of the biggest companies out there when it comes to semiconductors. This is the company that basically makes every single chip out there for all the companies out there. Okay, every single, including Microsoft, including Apple and so on. They design their own things. They go to this company and this company makes it for them. It has a market cap of $425 billion. Moat, it has a wide economic moat. It has a price $87 per share. Dividend yield is just above 2%. The payout ratio just above 30%. The latest increase was almost zero. The 5-year growth rate is only 7%, and they haven't increased it basically every single year, so that's probably why there's zero. The annual payout is $1.88. The safety is 62%. The profit margin right now, profit margin is 43%, which is huge. Return on equity 33%, almost a 34%. Return on invested capital, we're looking at almost 24%. And it has the free cash flow of $9 billion of free cash flow, and this $1 billion US dollars, not their money. Total return in the last 10 years, we're looking at about 19%. Next year, they're expecting their earnings to grow about 21%, and then after that, about 6% every single year. Remember, this comes from the analyst, so that's basically, you have to think about that. Okay, it can be basically accurate, or it cannot be accurate. Sometimes they predict things and then it might not turn out that way. The economy might change. All of a sudden this 6% becomes 8-9% if the economy starts booming. A lot more companies need those chips and so on. The Morningstar valuation right now, it says 36% discounted right now. $137 per share is where they expect the price to be. The next company we're looking at today is Starbucks, another company that I've spoken about recently. It has a 106 billion market cap. It has a wide economic moat. Price right now is $92 per share. The dividend yield is 2.3. The payout ratio is 64, which is slightly high, but the latest increase was 7.5. The 5-year growth rate of 14%. And the dividend streak of 12 years in a row, which is really good. The annual payout, we're looking about $2.28. The safety from Simply Safe dividend is $67%. The profit margin is 10%. Now, return on equity, basically, I'm going to explain this to you guys now, because some of you have asked me before, how does the company have basically a negative return on equity? And there is a reason for that, and this is what is called negative shareholder equity. What that means is this: if you go to Yahoo Finance and you go to the section on the balance sheet, what you will see is the total assets of this company. Okay, and you also have the total liabilities. So the assets is the company, the stuff that company owns, that are, normally you have a total assets and basically the current assets. So the total assets, every single thing the company owns that we can liquidate today if we needed to. And the total liability is how much basically the company needs to pay, right? More or less. So what's happening here is the company has more liabilities than total assets, and for that reason it has what it's called negative stockholder equity. And because it's got about $8 billion, there's nothing to worry about here. The fact that it's basically down, it's not too much worry, because the company has some free cash flow they can use. They've got other assets that they can liquidate. But the most important thing is, and the company is still revenue side of it, I think they're making, total return, they make basically total revenue of making $37 billion. So I wouldn't worry too much in terms of the return on equity, but of course some investors might be put off just because of that. So I just want to make that clear. That's the reason why basically the company has a negative shareholder equity, and for that reason, which is basically in this one, there are the different reasons why that might happen, but for this company, it's because it has more liabilities than total assets right now. So return on invested capital is about 29%, free cash flow 2.89, total return in the last 10 years we're looking at about 11%. Next year they expected the earnings to grow about 18%, then 16% after that, okay, and then 10% discounted right now on $103 per share. This is one of the reasons I'm considering it. The company is discounted right now. I'm really looking at this thinking this is a double-digit growth for a company that's been around for a while, paying excellent dividends, okay? Although the payout ratio is slightly higher than I would like, they've increased that for 12 years in a row, and the safety is about 67%. So I'm currently looking and basically debating whether I should add this to the portfolio, inshallah, but I would let you know if what I decide. The next company is the only company that I only own, basically that's on this list. Okay, that's UPS, 131 billion market cap. It has a wide economic moat, $153 per share. Dividend yield is 4.21%. I actually didn't know it was that high right now. The payout, I knew it was about 3 something not long ago, but the payout ratio is only 55%, which is fine. Latest increase was almost 7%. The 5-year growth rate is about 13%. The dividend streak of 13 years in a row. The annual payout we're looking at $6.48, and the safety was almost 70%. Profit margin almost 14%, return on equity 40%, and return on invested capital about 12%. Free cash flow right now we're looking at $6.2 billion. Total return in the last 10 years we're looking at about 8%. Next year they expect the earnings to grow about 11%, then about minus 2% after that. Again, you have to think about the bigger picture. If we end up in a recession, this might be the case, but if we don't end up in a recession, things are booming, people are buying things from Amazon and all of these places, this company will be the company that's going to benefit, because they're going to deliver all the goods that's basically floating around, and for that reason things can change. But right now they're expecting the earnings to grow 11% next year, then basically a negative growth for the next following maybe 5 years. The Morningstar is saying it's 11% discounted right now. $172 per share is basically where the price is at right now. I'll be honest, I'm looking at it now, UPS, although I don't want to include, basically add to my industrial sector right now, it has come down quite a bit. So I'm looking at it now, I'm thinking maybe I should buy a couple of more shares, inshallah, moving forward. The next one is TMO, or Thermo Fisher Scientific. This is one of the basically the healthcare companies, 195 basically billion market cap. So it is a huge company. It has a wide economic moat. Price right now is almost $500 per share. 0.28 dividend yield. Payout ratio only 6%. 17% increase in the last, basically latest increase. The 5-year growth rate of 15%, which is absolutely huge. Dividend streak 5 years. Annual payout $1.40. Safety 72%, profit margin 13%, return on equity 13%, return on invested capital about 8%, free cash flow right now $5.85 billion, total return in the last 10 years almost 19%. They're expecting the earnings to grow about 10%, then 6% after that, 17% discounted right now. $600 per share is where the price should be. So there's $102 basically away from where it is right now. This is one of the companies I really wanted to add to the portfolio very recently, but I decided against it because I do have AstraZeneca that's still undervalued. I want to buy more of that. I want to buy more of Medtronics before I introduce another healthcare company. So that's why I was a bit hesitant. And then so yeah, for that's the reason. But again, it's still on my watch list, so I will see how things go from now on. But 17% discounted right now, see, basically is very, very tempting. The final company that we're looking at is the LIN, or LIN. This is one of the material sector. Is very similar to air product and chemicals. 180 billion market cap. It has a narrow economic moat. $169 per share right now. Dividend yield of 1.38, payout ratio 37%, which is quite low. Latest increase was 9%, which is absolutely huge. 8% in the last 5 years, and then dividend streak of 30 years. So this is one of the dividend aristocrats, the only dividend aristocrat on this list, and that is a company. Dividend aristocrats are companies that have paid their dividends 25 years or more. Kings are 50 plus years. Annual payout, oh, this is wrong. It's not 99. I wish it was. It's $5.10. Safety 77%. Profit margin right now we're looking at about 17%. Return on equity we're looking at about 14%. Return on invested capital about 11%. Free cash flow last basically this year is $5.4 billion. Total return in the last 10 years about 13%. Next year they're expecting the earnings to grow 9%, and they're expecting 12% growth after that, and 2% discounted right now. $379 per share is basically where the price is, so just 2% discounted right now. If, to be honest with you, if you're interested in a basic material sector, you might just want to wait a little bit longer to maybe give yourself at least a 5 to 10% discount. Then you might be able to initiate a price. Again, I'm not a financial advisor, so please don't take this as advice. I'm just giving you some information. And before we finish the video, I want to show you Sharia compliance side of things. All of these companies are fine. The only one that you need to watch out is Starbucks in terms of interest-bearing debt. Interest-bearing securities, absolutely no issues with that. You can pause the video to have a look at each individual stock. That's what I wanted to share with you guys. I've got another video planned coming up for non-dividend paying companies, and then I've got some UK companies and so on. If you have any stocks that you want to also look at in the next couple of days, let me know. I'm more than happy to check if it's individual stocks or whatever it is. Just let me know, inshallah. I will check that. As you can see, the portfolio, it has come down a lot from where it was, but again, I'm still adding money to it. So today I will be spending this much, and I will share that with you guys on the Discord, inshallah. Have a wonderful day. Assalamu Alaikum.